Today, we're going to talk about private equity funds and why they're structured as limited partnerships. Stick around to the end, and we're going to talk about this interesting situation that a limited partnership structure created when an investor was trying to exit their position in one of the largest social media companies out there. All right, so first, what is a limited partnership? What is a private equity fund? Now, a private equity fund, in essence, is a fund designed to invest in companies that are privately held. Now, the world of private equity is really broad. Everything that's not publicly traded is considered private equity. So if you go on your Robinhood account and you start trading stocks on Robinhood, those stocks are public equities, and what we're talking about today is private equity and stocks in private companies. Private equity can be further broken down into kind of growth equity or late stage or leveraged buyout private equity, which is typically when you hear the word PE or PE investing or private equity, usually it's referring to leveraged buyouts where funds are coming in and buying the entire company. But it also can refer to growth equity, venture capital, early stage investing as well. Now, both types of investing typically are structured with limited partnerships. A limited partnership is basically just like what it sounds like. It's a partnership of a bunch of different investors who come together. And they are limited in terms of the types of controls that they have. And we're going to talk about the limited aspect. But the first piece is just the partnership. So this would be like you and a few of your buddies, you all come together and you pool your money together into a legal entity like an LLC or a partnership. And that entity then becomes this fund that goes out and makes investments. That would be the partnership. Now we add on the limited partnership side of it. Now the limited partnership piece refers to the fact that these partners who are investing in this fund are limited in terms of the amount of control that they have, but also in terms of the amount of exposure that they may have. They're really protected both from a reputation as well as liability perspective. But the trade-off is they give up some control for that. There are other benefits as well that we're going to talk about in just a minute. If they're limited in terms of the control that they have, who has the control? Well, the control sits within what's called a general partnership. Now, a general partnership is another legal entity that maintains control over directing funds and making decisions on behalf of the limited partners. Why are private equity funds and venture capital funds and all other kinds of private and alternative asset funds structured as limited partnership structures, or oftentimes what we call a GPLP structure, or general partnership, limited partnership? The reason for that is because there are certain advantages. So I talked about a few of them. For one, if you're an investor in a limited partnership, you're a limited partner in the fund, then the only capital that you have at risk is the amount of money that you put into the fund. If a company does poorly and gets sued and they try to come after all of the shareholders and the investors and so forth, your exposure is limited to what you've invested in the fund. So that's one reason. This dates back to the 1960s and 1970s when some really smart tax attorneys figured out that if you structure things with a limited partner, general partner structure, then the gains, the commissions, etc., that are paid to the general partner as income and compensation for managing the funds on behalf of the limited partners can be taxed at capital gains rates instead of ordinary income. And this is what's oftentimes called as the carried interest loophole, where essentially private equity managers, are getting paid what's called carried interest, which is essentially like their commission on the profits. It roughly represents anywhere between 20 to 30% of the profits on their investments that they generate. So the private equity investors are going to receive this carried interest as their cut of the gains on the investments. That carried interest, or those gains that they've generated and that they're being compensated with, get taxed as capital gains instead of ordinary income. And depending on the current tax code, that could be anywhere between 15 to 25% paid in taxes to upwards of 40+%. So huge delta in terms of that percentage difference. And that's why a lot of private equity investors have gone out and structured these funds as limited partners, general partner structures. There are some other benefits too. If you are the investment manager, you don't want to have to go to every single partner in your limited partner structure every time you want to make an investment and get them to approve the investment. Sometimes they don't have the insight of what's going on. Sometimes they have conflicts of interest, right? So maybe you have a large beverage company that's an investor in your fund, and they don't want you to go and invest in a potential competitor, but you know that it's a great investment and can drive great returns for them as well as the rest of your investors. And so maybe you want to be able to do that. So it helps kind of limit conflicts of interest. Okay, so lots of potential benefits for limited partners and for general partners, which is why they get structured this way. Now, ultimately, there probably are, or potentially could be, other structures that are more beneficial to limited partners. But at this point, it's become so standardized, this limited partnership, general partnership structure, as well as the fee structure of charging 2% management fees and 20% carry and et cetera, that if you try to do something that's kind of outside the norm, unless you're a big fund like Sequoia, who has a super long reputation and everybody's dying to get into their fund, unless you're one of these outside cases, it's actually to your benefit just to keep things really standard if you're starting your own fund and trying to decide which structure you're going to use. Because investors, they're going to want to go with something that they're familiar with. And if you think about like all the risks involved in investing in this space, right, then do I want to take the risk of a brand new structure and a brand new investment strategy? Or do I want to just say, hey, I'm very comfortable with the structure, I'm going to invest in this new strategy? So that's one of the reasons why it also, is kind of standardized at this point and pretty well defined. So what are the downsides of a limited partnership? Well, the first and most obvious probably is that if you're an investor in a limited partnership, you're limited in terms of what you can do and what you can decide. You are basically signing up and committing to a long-term relationship with this general partner, this investor that's going to invest the money on your behalf. And as such, you may not always agree with the investments that they're making, but you have very little say. You likely will have very little access to information of how those companies in the portfolio are doing. Now, oftentimes you can have conversations with the general partner and ask them about how the portfolio is doing, but you don't always have control over that. And that can result in, times where you get caught kind of blindsided, right? You're entrusting the general partner to do their job. If you look at FTX that recently blew up, they raised hundreds of millions of dollars from some of the very best venture funds out there. And all of that money essentially disappeared seemingly overnight. And so as a limited partner, you may not have felt comfortable with that investment at the time, but your investors, your general partners, they chose to make that investment and move forward, and they pulled you right along with them. So there can be some disadvantages. The other is, because you don't always have control, there might be some liability risk. So, for example, when Mitt Romney was running for president, he had invested in a fund. That fund had invested in Ashley Madison, which is like this. If you don't know Ashley Madison, it's a website for people that want to cheat on their spouse. It's like a dating network for people who want to cheat. And so he got all caught up in it because they were like, oh, well, Mitt Romney says that he's this like family guy, and then he invests in companies like Ashley Madison. Well, in his defense, like, he was a limited partner. He didn't have control over what they were ultimately going to invest in. And so those are some of the downsides. That even though he took a reputation hit, even though it wasn't his decision and probably not something he would have supported to begin with. Here's one of the other downsides. So I've talked about some of the downsides of a limited partner investing, and I've talked about a lot of the upsides for the general partner. But here's one of the downsides for the general partner for investing through a limited partnership structure. So as we come to the end, I want to tell you the stories about how these LPGP structures can play a major role in impacting the profits and the returns that investors can generate through these investment vehicles. So we're close to this other fund, and they were an early investor in one of the largest social media platforms in the world, and growing super fast. And their stake was worth an insane amount of money. I think it was worth probably close to like 5 times the size of their entire fund. Right. So they had made like some minuscule investment, like maybe $500,000, and had turned that into like close to $1 billion. So huge potential return. But these funds, they last for about 10 years. That's the agreement. So the general partner and the limited partner agree that for the next 10 years, The general partner will take the limited partners funds and invest them in companies, and at the end of the 10 years, they will return the money back to the investors. Well, as you can probably imagine, this social media company had been around for a while, and it was well over 10 years. And the limited partners were like, hey, we want our money back now. We don't want to wait. And the investor was like, hey, but I can see that this company is going to go public, and I think it could double from here, which means we're going to go from $1 billion of potential profits to $2 billion of potential profits. And he's thinking in his head, he's like, I'm going to get 20% of that, which means that's like $200 million in today's value. And if I wait till the IPO, that could be $400 million. Like that is crazy amounts of money, right? So he was kind of pushing back on the investors saying, hey, we don't want to sell now. Let's wait for the IPO. It's going to be great. And they were like, look, we're already going to get this insane return. We'd rather lock it in now and get our money back. We've been sitting on this thing for over a decade. And so it forced him to go and find other buyers for his stock. So he went and he found other buyers who bought at that $1 billion valuation. And then they wrote it up to the 2x when the company finally went public. But to his credit, he didn't sell the entire position. What he did is he said, okay, look, what I'll do is I'll go and sell enough to get you your money back that you put into the fund. So whatever the fund size was, like, I don't know, 100 million, 200 million, kind of doesn't matter. Like, that's how much he sold. That way he could give them back their money and they would be happy. So as you can see, these structures, they have real consequences. In his case, he was over the 10 years. And so his limited partners were like, hey, we agreed for 10 years, but it's been over 10 years and now you owe us our money back, right? So they had a lot of pressure and control that they could kind of push on him. The other thing is, oftentimes limited partners will be like, hey, I'm not going to invest in your next fund until you return the money from the first fund. And so that can be another kind of challenge within these structures. All right, hopefully that was interesting and you learned a lot about limited partnerships and why private equity funds are structured as limited partnerships. Check out my other video where I talk about how to start a private equity fund with no money.